Hey, happy Monday. We are here in another Fed week where the FOMC committee is going to likely raise interest rates, which is really interesting. In the past couple months here, we've had a few rate hikes, and we'll dive into more about why and what's to be expected ahead. The really important thing is, how do you trade ahead of the Fed, right? So that's what we're going to cover here today. Now, important reminder that trading and investing can be extremely risky business. Therefore, it's your responsibility to evaluate any information, opinion, advice, or other content contained in this video. So we're going to use the E-mini S&P 500 futures, my baby, that I trade and analyze multiple times a week to get a grasp on what do we do in a Fed week, all right? So here's the thing. The Fed announcements are always on a Wednesday at 2 p.m. Eastern. So you can see that we have these past Wednesdays marked here where there were recent meetings here in 2022, and we have the next one coming up on July 27th of 2022. So today's Monday, and that's coming up on Wednesday. Now, getting ahead of the Fed means being aware of what the Fed is planning to do, but also the alternate possibilities, all right? So right now we're in an environment of rising interest rates because inflation has been quite high. Now, whether you're on the camp that says, oh, inflation's peaked, we're coming down, or no, we're still in trouble with inflation, whether it's gas prices, food prices, or anything else, then it doesn't really matter which side of it you're on. What you need to be aware of is what the Fed generally looks to do in a high inflation environment. So their job is to have kind of stable prices. So when inflation is making prices not so stable, they want to come in and hike rates to help ease that. But the thing is, they may hike rates by 75 basis points like they did in June. That's what the consensus is as of like this moment. It kind of changes as we get data. But there are some whispers that they could raise a full point, 100 basis points. So what you need to be aware of is what are the expectations of the Fed coming into the market, all right? That's not something you get from the chart. That's something you get from paying attention to the news and researching this yourself. Now, you don't have to have the talking heads on in the background all day to figure this out, okay? A quick Google search will help you. But that's where I got that, okay, we're expecting a 75 basis point hike. That seems to be what's most likely. But with some rumors of 100 basis points, which would be more severe, the market, the S&P, the E-mini S&P could not like that, all right? So that's tip number one, is to know the news, know the expectations of what the Fed might do. Number two is come back to your chart and mark out what has happened with the recent actions from the Fed, either in the recent time period, which we happen to have here, or hey, maybe you're watching this video again in the future and it's a time when we haven't had a rate change in a while. Then go back to a period when we did. So let's take a tour here. Let's look at March 16th, 2022. Okay, we had a 25 basis point rate hike. And you can see it looks like that was sort of baked in. Okay, the market kind of knew that was coming. It was like a little bit of medicine for this high inflation we were experiencing. And so it was not perceived as a bad thing. Prices rose into that and they continued past that. But that was also a relatively small hike. Things continued to escalate as inflation continued. It wasn't peaking as everyone thought. So you can see here, guys, into the 50 basis point rate hike on May 4th, the market rallied, but then the rate hike came in and the market continued to weaken after that. Now, coming into the 75 basis point hike in June, again, as these plans are laid out by the Fed and become more expected, the reactions can vary, okay? They're not always severe. So in the June rate hike, again, we had a little bit of a rally just for a couple days and then fell again. Now here we are coming into July 27th. So what you can see here is that price action had broken out of consolidation range. And I covered this in my last skinny dip video. So we're on a pathway where there could be room for further upside, but also last Friday was key timing for the S&P. So we're at a standstill in terms of whether the market wants to go up or down, and watching the direction that it takes into the news will help you when the news comes out. So here's what I mean. If we start to rally, okay, on Monday afternoon and Tuesday and further on, then that creates more of a likelihood that when the news actually comes out on Wednesday, that the market might pause and turn lower. It's not a hard fact, it's a guideline. If we start breaking lower Monday and Tuesday, we start weakening ahead of the news, then it could be a little bit of a release of buying pressure, which then surges up again if we get the expected 75 basis point hike. Again, with these Fed rate hikes or rate drops, as a situation might be in the future, it really depends on the amount they do, because there's a certain amount that's expected or baked in based on the recent economic data, on inflation, on jobs reports, etc. It's when the Fed kind of does something not expected that it usually creates a lot of flurry, all right? So you've got knowing the news, you've got understanding where you are on the chart and knowing the date that we're coming to relative to past hikes. And then last but not least, which is really the most important thing, is to have your plan of action ready, okay? So my personal plan of action is that I don't trade at 2 p.m. Eastern on the day of a Fed announcement. It's going to create a lot of volatility and opportunities, yes, but that doesn't mean I have to trade that hour and deal with the whipsaws. So what I mean by whipsaws? Well, let's open this up to a 60-minute chart and go back to June 15th. So let's just take it to a 60-minute chart and go back in time. I'll see how far my chart allows me to go without adjusting the settings, and look at how the action was on that rate hike day. All right, here we go, guys. You can see here that this was the bar ending at 2 p.m. Eastern on June 15th, right? That was the date of that hike. And look at the size of the candlestick that it formed after. Look at how it traded up to 38.2975 and down to 37.23.5. Well over 100 points here in just an hour. That's a lot of volatility. And if your plan isn't built, if you don't have experience to deal with volatility like that, then stay out of it, whether it's the ES or the NQ or whatever during that hour. And what you should watch for is what unfolds afterwards, and then be able to take action upon that. So you can trade the action going into it and trade the action that's come out of it, but you don't need to feel pressure to trade that hour, okay? This isn't a video about how to trade when the Fed announces. This is about how to navigate your trading around all of that to be best prepared for opportunities that may lie in front of it or after it. So let's come back to the daily chart here. And keep that in mind. We might have a really volatile swing within the day at the time of the announcement. And that's where you can still come in and use your trifecta tools, price, time, and momentum, to be prepared for any opportunities that unfold. All right, so you've got what you need now to be ready to trade ahead of the Fed. You know what time is coming, that report, and how the market reacted to recent ones. And you can follow me along in the skinny and the mini, where I'm going to detail the short-term resistance, support, and everything else that is playing out in the E-mini S&P coming into the Fed announcement. So remember to subscribe, like, comment, follow, and join my tribe if you haven't already, and I'll catch you on the inside. You can sign up for the link to join my tribe and get my hot, timely, actionable updates as soon as I publish right to your inbox.